From Edinburgh to the City of London and to the top of an asset management giant. Today, she oversees more than $300 billion of assets for nearly 2.5 million clients, with investments that span the globe. Anne Richards' journey began in Scotland. Born and raised in the capital, she got her degree in electrical engineering from the University of Edinburgh. Electrical circuits gave way to the buzz of finance. Richards went on to an MBA at INSEAD outside of Paris. Overseeing investment strategy at Aberdeen, sweeping changes at M&G Investments, and taking the reins at Fidelity International in 2018. A champion of gender equality, Richards called out a laddish culture in financial services. But the asset management industry is changing, and not just culturally. Negative rates, the push for sustainability, and the rise of passive investment make for a very different landscape. From Bloomberg's European headquarters in the City of London, today on Leaders with Lacqua, we meet Anne Richards, the Chief Executive Officer of Fidelity International. Anne Richards, thank you so much for speaking to us. So you have passive investments, ESG negative yields. What has been the most significant change in your industry in the last 10 years?
I actually think it's the way probably that monetary policy has played out in markets. Because if you roll back 10 years ago, post-crisis, and actually just at the very advent of unconventional monetary policy, I think at that stage everybody anticipated deep recession, inflation coming back as a result of monetary policy, we'd have a short, sharp shock, we'd have an inflationary burst, and we'd be in a conventional economic cycle. And actually what you've seen is something that played out very, very differently to anybody's prognosis in advance of that. Bond yields have stayed lower for far longer than anybody anticipated, all the way down to negative rates now, which is in a completely new paradigm. It was a long, slow recovery in a GDP sense. And of course, equity markets in particular have really been off to the races for a large part of that period in time. So I think if you roll back, the way that markets have responded and this new economic paradigm that we've been in has been the thing that has changed thinking the most in our industry.
But has it been better or worse? Because we're at a time where we're end cycle, we still haven't really normalized, unclear to see when the next window is, and we could see a downturn just because of where we are.
So I think from the perspective of the asset management industry, it's probably been a better decade than people anticipated 10 years ago. Now, there have been some trends within that. Obviously, passive investing, which you mentioned, has been something that some parts of the industry have really benefited from, and we've absolutely seen that played out. I think as we come in to the next decade, we're starting to think about how we need to react and change our operating models to respond to what seems to be this continuing sort of unusual set of economic circumstances, and I think the industry is still adapting to that.
And so how do you think that will change things for the industry and for Fidelity?
Well, I think for the industry as a whole, we have to really understand that the top line, the revenue, forget about assets under management, the actual revenue that we earn from those asset managements as a whole is declining year on year. We're seeing that pricing pressure coming through. It's been more acute in passive actually than it has in active, but we're seeing it everywhere. And I think that the industry as a whole has not been good at recognizing that top line deflation and what that brings. It's been masked, I think, by the rise in market levels, which have been a cover to some of that stuff. So I think the industry has to get a lot better about thinking about its operating model, and certainly at Fidelity, that's one of the things that we're absolutely focused on. What is our operating model? How is it that we can respond to a very changing set of economics for the industry? And in doing that, we have to start by being client-led. So one of the consequences of everything that's happened is we're seeing the demand for services from our clients increasingly exceed almost the demand for pure product. We have many, many conversations now about a much more holistic offering rather than simply saying, what fund do you have that we can fit in this slot? And that's a really big change for the way we organise ourselves, and that's really where we're thinking very hard about how we shift and shape what we do to follow that client need, that client demand.
But will we ever really go back to active investing in a way that we'd seen in the past?
Active investing is absolutely key to a successful economic model, because active investing is about the allocation of capital and moving capital towards businesses which are likely to be more sustainable, more successful in the long run, and away from those businesses where, frankly, we see an industry in decline or a business in decline. That is at its root what active management is all about. It sometimes gets lost in the noise, which is why I think that we can never move away from a world where active management isn't a really important part of what we try to do as investors. Now, the shift in the balance between passive and active is something that we can debate, but that fundamental need to actively allocate capital is one I do not believe that can go away in a market-based economy.
Coming up, the climate is changing, and so too is investor appetite. The need for green is storming portfolios, and Richards weighs in on a new generation of investor.
The millennial generations, they care far more about the world they will inherit from their parents and their grandparents, and they want to use their investing leverage.
Melinda Gates, thank you so much for joining us on Bloomberg Studio 1.0.
Bill and I always look for any philanthropy we do to fill some of those gaps.
I'm Emily Chang, and this is the best of Bloomberg Technology, where we bring you all our top interviews from this week in tech.
I think Facebook's how we won in a lot of ways.
Do you ever take any of the tips and give them to your LA Clippers coach?
No!
I will stand up for Canadian interests. I will only sign a deal that is good for Canada.
Coming up on Bloomberg Best, the stories that shape the week in business around the world.
Welcome to Bloomberg Big Decision. Really good to have you here.
Thank you so much for having me today. We know this business inside and out.
You've really built a conglomerate.
We saw amazing opportunities in the Middle East.
They had the dream, you had to bring it to reality.
Between the three of us, we can really do anything.
I feel like this is where we should go.
From the European Commission to the world's biggest asset manager, BlackRock, everyone is talking about climate change. Investors are focusing on sustainability, and increasingly, capital is being allocated according to environmental, social, and governance criteria. And it's not just active management, but the passive money too. Cash is flowing into ESG ETFs like never before. If you manage more than $300 billion, you've got to give clients what they want and still get them what they need, return. How does the Chief Executive Officer of Fidelity International, Ann Richards, balance the hunt for yield with being a force for good? You're talking about being client-led. What do clients ask of you?
I think clients have been wrestling with some of the real conundrums in markets apart from anything else. I think the search for yield, for income-based investing has been so difficult in recent years and negative, particularly in parts, for example, of continental Europe, where you've got huge swathes of the bond market that has been trading at negative yields for quite a long period of time. That is a real issue if you are trying to deliver a certain level of income to an aging client base, which is true for many of our clients. So we increasingly see clients coming to us saying, how do we solve these particular conundrums? I think there's another thing which is a very, very clear trend, is the idea of simply coming to an asset manager for building block funds. I think that's changed quite markedly. We are seeing much more desire and drive for things that fit a particular emotional aspect or a particular part of the investing framework. So for example, about a year ago or so, we launched a water and waste fund, a fund specialising in water and waste. Been incredibly successful. We raised over $1 billion in assets because, as part of this increased interest in how you create a circular economy and how you bring some of the environmental or social factors actually into an investing environment, that was a fund which was focused on a particular area where a particular group of clients really were concerned about how they could invest in that area to support and grow a particular area of initiative, if you like. And I think finding those areas which really align to what clients are trying to achieve is part of what we need to keep doing as investment managers. I think people don't come to active managers for those basic building blocks in the way that they did 15 or 20 years ago. Give us your best European fund, give us your best North American fund. It's more sophisticated than that now, and we have to respond to that.
But if you look at ESGs, are there many more clients asking now about how they can do mindful impact investing compared to 3-4 years ago, and why the shift?
I think there's a bunch of different things that come together. So from our direct customer base, we see that particularly things like the millennial generations, they care far more about the world they will inherit from their parents and their grandparents, and and they want to use their investing leverage, limited though it may be at this stage, but over time you can see that they want to orient themselves towards the things that matter to them in terms of a more holistic view of the environment, of the planet, of the climate, or whatever. So that's definitely
and this is real. It's not just it's not people saying I want to do good but then invest in a bit of everything.
No, I think we're seeing from individual customers, not all customers, but individual customers, that trend is definitely there. I think on the institutional side as well, it varies a lot. There is no one size fits all. I absolutely acknowledge that, but we are seeing really clear demand from large parts of our institutional client base. They want to see more engagement on some of these issues. Yep. It's not about divestment. They want to see us continue to own shares in companies that might be having not a great environmental impact today, because they want to see us working to improve that impact over time. It's all about the change, and it's one of the reasons why we launched our ESG ratings internally. So every single company that we follow now, we will rate on our ESG factors as well as the financial factors, and that's really been built into the entirety of our investment process. So it's becoming mainstream. And I think one of the key messages that sometimes gets lost in this is that financial returns really matter. They really do matter. So thinking about some of these other factors is not instead of being able to deliver financial returns. We think over the long term it will actually enhance the financial returns, and we're trying to build up the evidence base, the body of evidence, to point to the fact that we can demonstrate that those companies which are working harder to improve the situation over time will develop better returns.
On ESG, for example, what do you need? You say that you measure, right, internally, I imagine, but do we need a better definition of what is sustainable and what isn't, and are we going to get it in the next 2 years, globally?
Are we going to get it in the next 2 years? I'm certain that we are not. I mean, there are a whole range of different taxonomies. We've got different, whether it's the EU, whether it's in the UK, whether it's in other parts of the world, we've got different people really tussling away at this problem. I think we're very unlikely to get a single taxonomy. I think it would be helpful to have one, but what I say to the companies, I've had more than one company management say, what do we do? We're getting 5 different ways of having to do this. Focus on the real, focus on the improvement, focus on what you're doing as a business, because the people that are serious about this, they're not really concerned about box ticking. It's about what you are actually doing. What are the conversations you're having around the boardroom table? What practical steps are you taking in your business? How do you know, if you're sitting on top of a business with 50,000 to 100,000 employees across 10,000 different sites, how do you, as a board, know really what's happening in that? And if you can't answer that question, go away and find out what the answer is. So it's trying to, then that's what I encourage people to do, really focus on the real change within the business. And then what we're trying to do is we're trying to, for every individual industry, we're trying to rate and rank the companies within the industry about how well we feel they're doing against their peers in that industry. And for us, that means we will build up the database, and we will get the evidence base that says, actually, these are the sorts of things that makes a meaningful difference.
How's your client base changing? Are they younger? Are there more female investors?
So the rise of the female investor is definitely a thing. I mean, we've been running a Women in Money campaign, which has got extraordinary traction over the last year or two, which is fantastic to see. There are some interesting nuances between the average male investor and the average female investor. I think those will close over time, but we've historically been an industry that has tended to talk in quite male language. We like jargon as an industry. That we've found has been quite off-putting to women, but women increasingly have control of the family finances right around the world. So we're beginning to see a better conversation and a dialogue, and I think one of the things we're trying to do as a business is shape the way we speak to our customer base and our client base in ways which are more inclusive generally, rather than, I think at times as an industry we've been a little off-putting sometimes in the language and the way we pull people into investing for the future.
Up next, Anne Richards shares her recipe for success and being prepared for that decisive moment.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you in interesting places.
A circuit board, complex, meticulously crafted, and if one thing goes wrong, it just won't work, much like a well-tuned business. Maybe that's why Ann Richards' training as an electrical engineer has prepared her so well for life in finance. Her career has been focused on the data, and while that might lend itself to micromanagement, Fidelity International Chief Executive Ann Richards still has a clear focus on the macro and what it takes to be a leader. And Richards, you were an engineer by background before going into finance. How has that shaped the leader you are?
Goodness, that's a big question. So yes, I originally was an electronic and electrical engineer, and I started my career at CERN as a research fellow initially. And I think it has coloured the way that I think and the way that I see problems. As my team know, ad infinitum, I'm always talking about Lego bricks and pictures. I'm always trying to think about how you think about processes, how you think about end-to-end delivery. And of course, data is a big thing in our industry. Historically, we don't treat data as an asset. I'm quite a data geek. We need to get our data right, and if we don't get our data right, nothing else matters. So I think the engineering background absolutely comes through every single day that I work. But I think the thing that I feel I've changed over the years is that I started really as a deeply analytical person. That was my background, maths and engineering, and every problem was analysed in terms of numbers and so forth. And over the years, I've become more and more fascinated actually by the psychology of people and how you bring people together to solve problems. So as an engineer, you're always a problem solver. It's always what you want to do. And the power of the hive, the power of the team over the individual to solve problems, I suppose defines the way I try and lead a business and bring people together to solve problems. So I'm lucky I have a cognitively very, very diverse team. I have everything from ultra philosophical idealists all the way through to really, really process-led, fine detailed, organizational people, or the whole spectrum across that. And I find that immensely fun and stimulating. I do like to have fun when we're at work all day. I think there's no point in coming into work every day if you can't have fun. So I like to have people around me who also really love what they do. And I think we can generate a lot of energy when they do that. I mean, in your question on what advice would I give my younger self, it's worry less. When I look back, there was all sorts of stuff I worried about. Now, there's some stuff you should worry about. If you can control the outcome, definitely worth putting in the thought about how you can shift things in order to maximize the chance of good stuff happening and bad stuff not happening. Completely believe in that. But actually, I think I spent a lot of time worrying about stuff which I had no control over, and I don't think there's much point in doing that.
But what does it mean being a business leader in 2020? Is it different in 2020 than it was in 2010, than it was in 2000?
I think in some respects it is different. I think the pace of technological change and the need to adapt to that change is one huge difference. The other thing I think is that the realization of a whole cohort of new employees for us and their changing demands on us as business leaders means that we're having to build very different working environments to the ones that we've historically done. People are realizing that when they come into the workforce age 20, 25 today, they could be working for 50 years or a lot longer. And that realization means, what does it mean to create a working environment that can continue to upskill and train and motivate people? Our longest serving employee has been with us for 50 years, Kurumoto-san in Japan, which is fabulous. And I think in the years to come, we'll have a lot more Kurumoto-sans.
But that's amazing. Is that culture? Do you worry about the culture of a company?
Yes. Yes, but the culture of a company is effectively, as somebody said to me just a couple of weeks ago, the culture of a company is effectively the summation of all of those conversations that happen around the coffee machine and in the meeting rooms. And that's quite a difficult thing to measure. What you can measure more obviously is the behaviours that result from those. And I think we are very explicit about the behaviours that we want to see from our people, and we will challenge and hold up and indeed reward people based on whether or not they're exhibiting those cultures. So as we go into 2020, the words that we're talking about, that we're wanting people to think about, is to be brave and bold and curious and compassionate. Those are the behaviours that we think we really want to emphasise as we go into 2020.
I know you're a big champion of promoting women, of getting women more involved in finance. Is that working?
I think we're making progress in our business. We've hit 30% women in senior leadership positions, which is a fantastic result, and I'm delighted that we're there. Diversity for me is much more than about gender, but gender is one very important metric in it. So we've got a lot of work to do. We're succeeding in attracting, I think, more women into the industry, but as a result of the fact that we've had, I think, a couple of decades where we simply didn't make enough progress, it's going to take a long time for parity to come all the way through. But we're making progress. And on the investing side, the Women in Money campaign that we've been running, trying to bring women into, as customers into our world and helping shape what we do for them as customers, I think it's also an important part of opening up and understanding and frankly helping us find employees of the future through the fact that we're making this more inclusive to people as customers.
What is the employee of the future? What are the qualities that he or she needs?
I think curiosity is important. I think lifelong learning is important. I think the ability to come in and out of the workplace in a way that is adaptive to the individual. I mean, we have gone from a world, my father's world, my mother's world, when they were working, which really was 9 till 5, and there was no part-time and there was no agile working, to the world we're in today, where when I have a conference call with my leadership team, somebody will be at home, somebody will be on VC on their iPad, will be all over the world. People will change and shape and adapt, and we've already got a lot better at that flexibility, but we've got to do a lot more, and we've got to give that flexibility right through the age spectrum. This isn't just about parental leave, it's not just about maternity, paternity leave. It's actually understanding that if you're going to work for 50 or 60 years, you maybe don't want to do that in one block. And how do we, as a workplace, bring people back in who've chosen to take some time out or gone off to do something else? So I think we have to develop that flexibility. And as a leadership team, with this more dispersed, sometimes more disparate workforce, how do we still make everybody feel that they are part of the same company, that they are collaborating, that they are working together? These aren't easy challenges to have, but the workplace of the future, I think the successful workplace of the future is the company that can make those things happen.
What do you like most about your job, and what do you like least about your job?
What I love most about my job is the variety of it. I get to talk to tech teams, I get to talk to HR teams, I get to talk to investment teams. You know, it's fantastic. I get to talk to customers. I love just the variety of what I do. What do I like least about it? Mornings. I'm a night owl. I'm not a morning person. I chose the wrong industry for somebody that doesn't really wake up until the second cup of coffee.
But so the piece of advice to someone who's maybe a trainee with Fidelity and says, you know, how do I make it to the top? What's your number one piece of advice to that person?
Say yes to opportunity. Opportunity never knocks at the door at the right time. When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on, come back in half an hour when I've had a chance to have my shower. Open the door and say, come on in and have a chat. Say yes to stuff, and it'll take you in interesting places.
And Richards, thank you so much.
Thank you.